Good afternoon, everyone. My name is Zhang. I'm a PhD candidate in finance department. And the topic I'm going to present today is one of study in my thesis. The title is called Diversity and Capital Structure. So in this presentation, I will firstly give you some background of how did I conduct my study. And then I will divide my presentation into two parts. In the first part, I will talk about my own findings. And in the second part, I will discuss about the literature and how my research contributed to the literature. Okay, so let's get started. So as you can see, here is the picture. There is a firm called Firm X in the middle of this picture. So if this firm is only operate in its home country, so we will call this firm as a purely domestic firm. However, if this firm has subsidiaries in different countries, so in this case, we will call this firm X as multinational firms. So for the multinational firms, cultural diversity is an inherent characteristic because as you can see, the culture for each country could be different from one another. So the question is how this cultural diversity affects the financial decision of the company, of the firm X in our case. So this is our research question. How does cultural diversity affect the capital structure of multinational enterprises or multinational firms or MNEs? To investigate this research question, we collect data from Orbis. So Orbis is a very comprehensive database. For us, that is very important because it provides the information about the country where a subsidiary located in. So based on this country information, we can reliably measure the culture for the corresponding subsidiaries. And also our sample include like more than 3,000 parent firms and 200,000 subsidiaries. So our sample is from the US listed companies, which meaning covers New York Stock Exchange, NASDAQ, and the AMEX. So our sample period covers 10 years from 2004 to 2013. Okay, so this is our sample. For the methodology, one issue for the corporate finance study is endogeneity. In our case, endogeneity could mean that cultural diversity is the relationship between cultural diversity and the capital structure is not truly the effect of from cultural diversity. It could be also a proxy for like a geographic diversity or political risk or something like that. So to deal with this, the issue about the proxy, we use the GMM model because based on the previous study, that suggests the GMM model is a very effective way to deal with these endogeneity issues. Okay. For the cultural diversity measurement, we use the centroid cultural diversity measurement, which means my cultural diversity measurement is based on the cultural distance. So cultural distance is the cultural difference between the parent firm and each subsidiaries. So I use this formula to calculate the cultural distance first, and then put the cultural distance into this formula to get the cultural diversity. So for cultural distance, we use Hofstadter. We mainly use Hofstadter cultural scores. For the Hofstadter cultural score, they assign the numerical score to different country according to this four measure of the culture. These four cultural dimensions, which is the power distance, uncertainty avoidance, individualism, and the masculinity. So Hofstadter gives a score based on each of these dimensions to each of country. So based on this score, we can quantify the cultural difference between the parent firms and the subsidiaries. And then we can measure the cultural diversity, so which is the key variable of interest in our study. Okay, so this is basically the background of how did I conduct my study. And in the next part, I will talk about the findings. So in the findings, I will firstly discuss the main result of this research, and then I will talk about the further test. So for the further test, I use sub-samples. I divided my sample into different industries to look at how the cultural diversity, how the effect of the cultural diversity on capital structure is different between different industries. Okay, so here is my main result. As you can see here, a bunch of numbers here. So the reason I include like growth, size, profitability, and tenability, and the interest rate is because this is these are all the factors that be proved by previous studies that can affect capital structure. So I control all these variables here. But what I want to emphasize in my study is the first one, culture diversity. So if you can see that in the first row, the culture diversity is our key independent variables. And for dependent variables, I use a different measure for the culture's capital structure. For example, the TD here stands for total debt. LTD stands for long-term debt. STD stands for short-term debt. And the TE stands for total equity. So which are all the components of capital structure. So what I found here is culture diversity has a negative impact on total debt, which means the higher culture diversity of the company, the less the company borrow money from outside. And further, we look at the long-term debt and the short-term debt, we find that this negative effect between culture diversity and the total debt is mainly driven by long-term debt. Actually, the short-term debt is a positive, have a positive relationship between the culture diversity, which means as the firm increases its culture diversity, this firm are more likely to borrow short-term debt but reduce long-term debt. Okay, if this firm, the firm with a higher degree of culture diversity want to raise long-term capital, the last column shows that this firm are more likely to use equity instead of long-term debt. So we try to find some explanations for this phenomenon here for our result. So they are basically, based on the previous finance studies, we have three explanation here. The first one is culture diversity can increase the obscure of the firm, which makes the firm more more vague, not very clear for outside investors. So in this case, if the investors are not reliably measure, the situation, what's going on in the company, the investors are probably reluctant to give the money to the company. And the second one is information asymmetry. Previous studies suggest that in different cultures, the information flow are different. So if the firm subsidiaries in different cultures, there are several different information flows from different manners, or probably different the ways. So in this case, it also can be affect the financial decision of the firm. And lastly, the agency cost. Agency cost suggests that there is a conflict of interest between managers and investors. For the multinational firms, the agency cost is more serious because for the multinational firms, for the subsidiaries, they are not compulsory to disclose their financial information. It's not like the parent firm. And at least the parent firm disclose their financial information because they are public listed firms. However, this is not the case for the subsidiaries. So if the subsidiaries is located in the very high distant culture countries, it's very hard for investors to monitor the behavior of subsidiary managers. So this, all these three factors suggest one thing, which is the higher culture diversity of the firm, the more risky to investors. Because, so this is the reason why if the investor are willing to lend money or invest money to the company, they are more likely to use a short-term debt, which is less risky compared with a long-term debt. Okay, and also probably if the investor is more risk-taking, they are more likely to use a total equity instead of the long-term debt. So this is our main result. Previous studies suggest that the capital structure can be different from different industries. So to look into our main result, so which industry driven our main result, we further look at we divide our sample into sub-samples into different industries to look at which industry has a more effect on our main result. So as you can see, for the long-term debt, there are 5 industries: mining, wholesale, retail, finance, and service. So this 5 industry has a significant and a negative effect of the cost diversity on long-term debt. So which means our long-term debt is mainly driven by these 5 industries. Whereas for the short-term debt, there is only one industry has a positive and a significant effect. But if you look at the number of observations here, manufacturing, this industry, it's actually which contains like more than 7,000 samples in our total sample size, which if you compare this observation with the other industries, you can find the sample size in the manufacturing industry is actually take up more than half, so which is actually very serious influence on our result. So we can conclude that in the short-term debt, the manufacturing industry has the most influence on our result. And lastly, for the total equity, we can find that several industries exclude the manufacturing and transport and utility. All other industries have a positive and significant influence on our result. So this is a further suggest that our main result of cost diversity on campus structure for these 3 different campus structure is not the overall case. It can be driven by different industries here. Okay, so this is my result. In the next section, I would like to talk about the literature. So there are several literature suggest that culture can affect campus structure. For example, Booth, so this is a paper published in Journal of Finance, which is a top paper in finance studies. This study suggests that the institutional factors governs the process of financial reporting and thus affect the campus structure of the firm. As we all know, the culture is one of the important informal institutional factors, so which is also one important to affect the process of financial reporting. And also Agrawal and Goodwill and Kwok and Tennessee. So all these papers suggest that the national culture determines the source of finance. For example, in some countries, the firms are more likely to raise funds from a bank, but in some other cultures, companies are more likely to raise funds from stock market or some other like other public finance channels. Okay, and also several other papers find that there is a difference in the firm level. There is difference in campus structure among different countries. However, all the studies suggest that national culture traits affect the campus structure. But all the studies are looking at the outside of the culture, how outside the culture affects the firm. So, but what culture diversity within a firm affects the campus structure has not been investigated. But this is so our paper are going to investigate these questions here. So our paper is motivated by several other studies, which look at which compares the campus structure of multinational firms and purely domestic firms, and finds that multinational firms have a lower leverage ratio, which is a debt ratio, which is a long-term debt, as we showed before, compared with the purely domestic firms. So, here are several studies. They find this phenomenon, but they are not give us very explicit explanation why this is the case. And so we argue that the culture is the fundamental factors that can affect the decision-making of the managers. And also, the culture is a very important consideration from investors' perspective. So we argue that the culture can be affect, influence, or at least to a certain extent cause this phenomenon. The multinational firms has a lower leverage than the purely domestic companies. And our paper are similar with some other studies, like Dokas and Pantelis. So they are looking at the geographic diversification, and they investigate how geographic diversification of the company affect its capital structure. And also the size, 2008, they're looking at the political risk of the subsidiaries. Okay, so so they look at the political risk is a kind of the formal institutional factors, and how this formal institutional factors affect the multinational capital structures. And the other study, Motto and Zhang, they compare the U.S. multinational firms and the Canadian Canadian multinational firms, and they find that although they located in the culturally similar settings, but their capital structure are also different. So our papers contribute to the several literatures. The first one is we contribute to the capital structure literature. As you can see, previous paper already looking at the political risk and the geographic diversification. So in our study, we look at the culture, so how culture affects the capital structure. And also we contributed to the capital structure literature. The previous study already looked at the other institutional factors like political risk. So we still seek like the culture influence of the capital structure. And lastly, we look at the culture and the finance. We contributed to the culture and the finance study. So previous paper finds that culture affects the capital structure, but they only look at the national culture outside the firm. So we look at the culture difference within the firm. So how this affects the capital structure of the firm. So hopefully we can shed some new light in all this different strand of literature. Okay, thank you.
Any questions for John in regards to this research? We have a couple of minutes here.
Yeah.
Oh, thank you for your presentation. I must confess, when I saw your title, I thought it was, something to do with cultural issues. But I was surprised that you're talking about figures and finance, which is an area that
Yeah.
But however, so what were you saying about the correlations between culture and the capital structure for organizations?
So cultural diversity, as I said, there are can increase from the investor's perspective, it can increase the risk of the firm because from the investor's perspective, it's not if the firm go to the country that is the different culture from the home country, investors are very hard to evaluate the situation of the firm. So in this case, investors are not willing to give money to this company. So if the investors are willing to give money, they are not want to take more risk. So this is the reason why I show here there is a positive relationship between short-term debt and cultural diversity, and the negative effect between the long-term debt.
Sorry, are you talking about the issues of power structures here?
Yeah.
For example, if USA wants to invest in Zimbabwe, they've got the financial muscle, you know what I'm saying? Are they going to impose their culture on Africa in Zimbabwe? Is that what they're saying? Is that what they're saying, or it's different?
It's different.
Okay.
Yeah. Okay.
I surrender.
Yeah. Sure.
Hofstede have more than 4 dimensions to measure the cultural diversity.
Yeah, exactly.
Reason you only choose 4?
Yeah. They also have like a long-run orientation and endogenous. I think these are two new dimensions. But we in our study actually I use these 2 dimensions as a robustness test for my result. But I still use 4 dimensions here. The reason is I want to compare with my research with the previous paper, to make my result is like more solid.
Thank you, John.
Thank you.
It was an interesting presentation, and I'd love to present you a small token for our appreciation of your presentation.
Thank you so much.
University Postgraduate.
Thanks so much.
Thank you.